We expect that in 2014 world growth will accelerate gradually, mostly because the strong headwinds that we've had in terms of private sector deleveraging and public sector austerity, those headwinds will start to fade a little bit, and we'll start to see the underlying growth in the world economy start to pick up. And this is true pretty much throughout the developed world, the advanced economies. But as they start to recover, they'll pull, as it were, the emerging markets as well. So the emerging markets will start to enjoy more export-led growth in the coming year. We do expect U.S. growth to slowly speed up. The U.S. is a quintessential example of a country whose growth was held back by austerity. U.S. growth was cut by a full percentage point because of tax increases and the so-called spending sequester. That's mostly going to go away in 2014, and we'll start to see the underlying growth of the U.S., which is somewhere between 2.5% and 3%, start to show up. Housing's strong. We'll start to see more capital spending. Consumers are providing a solid foundation for growth. So a lot of things are going to go right for the U.S. In 2014. Well, the good news for Europe is their recession is over and their recovery has begun, but unfortunately will proceed at a somewhat slow pace. And the reason is there's still a fair amount of belt tightening going on in Europe. Unemployment rates still very high at record levels. So there's a lot of things holding Europe back, but they will see more recovery. In particular, the central bank, the European Central Bank's been more forthcoming with monetary easing. Inflation's very low, so purchasing power is good. Confidence in the ability of the European politicians to deal with the crisis has risen. So all of this will help to keep growth sustained, at least, although at a very low rate in Europe. Indeed, most of the growth in Europe in the coming year, at least, in 2014, will be in Northern Europe. Many of the Southern European countries will continue to shrink, although not quite as badly as they did in 2012 and 2013, but they'll probably continue to shrink. We think that China will, in fact, be able to sustain growth of between 7.5% and 8% in 2014, probably on the high end of that range. Already, China's growth bottomed out somewhere actually in the first quarter of 2013, and since then it's picked up speed a little bit. A lot of this is thanks to the mini stimulus that the government put in place over the summer. That's paying off. If things get worse at all in China, which we don't think is likely, but if growth slows down, then would likely see more stimulus. But we don't think that's needed because China can probably sustain growth in the high sevens. Other emerging markets will benefit from the fact that the U.S. is doing better, Eurozone's out of recession, China's picking up. So they'll all be helped by this. And in fact, what we'll see is export-led growth in a lot of the key emerging markets of the world. They'll also probably pull back on some of the monetary tightening that they did as they worried about capital flight and inflation. But the biggest impetus will come from exports to the big economies such as the U.S., Europe, and China. Unemployment rates in the developed world will remain high, mostly because growth is still fairly sluggish. To really bring unemployment rates down sharply, we'd need a very rapid rebound in growth. And we're not going to get that. We'll get a little faster growth, but not enough to bring about a big drop in growth. So, for example, for the U.S., the unemployment rate will probably remain well above 6.5% in 2014. It'll be down from where it is right now, but still above 6.5%. Same thing in Europe. We may see it, the unemployment rate there come off the record highs of 12.2%, but it'll come down again very, very gradually. The concern is, of course, that unemployment and persistently high unemployment will be and become a political issue in the U.S., certainly in the 2014 congressional elections, and certainly possibly in Europe as well. The good news is that commodity prices have been flat over the last year and will remain flat in the coming year. And this will reduce inflationary pressures worldwide. In fact, the worry now is, especially in the developed world, that inflation is too low. It's been falling for a couple of years, and it's too low, perilously close to deflation. This is certainly true in Europe, less so in the United States. So what you have is commodity prices going nowhere. You've got unemployment rates fairly high still, a lot of excess capacity worldwide. So inflation is not a problem. Certainly a rise in inflation is not a problem. A fall might be, a further fall, but a rise in inflation is not really a problem. The Fed will start to scale back on its stimulus plans. It's an open question about what some of the other central banks are going to do. But the Fed's move is to start tapering its very aggressive bond buying purchases. I think just about everybody on the Federal Open Market Committee believes that they need to start scaling back sometime soon. The question really is when. IHS believes they'll do it in March. They'll probably start the tapering process in March. But they won't raise interest rates until sometime early 2015. Other central banks will also be on hold. For example, Bank of Japan, Bank of England, probably on hold throughout most of 2014. The one bank, big major central bank that may ease more is the European Central Bank. There's some thought that it might do some more of this quantitative easing, buying government bonds or some other aggressive move to get the European economies going again. Certainly in the U.S., we've done a lot in terms of deficit reduction. We've done it in an awful political way, with a lot of turmoil, but we've actually made some progress. So in fact, we can ease back, and we certainly don't see any additional tightening coming in 2014. And provided that additional tightening is not there, growth will pick up. Europe as well, there's a sense that the focus should shift away from austerity to growth. So you're starting to see some of the most troubled economies in Europe getting a little more time to meet their fiscal targets. So from that perspective, that really serious problem, growth problem that we had vis-a-vis austerity, the fact that austerity was just killing growth, that's mostly going to go away in 2014. The dollar will strengthen against most other currencies for two reasons. The first is U.S. growth will be quite a bit stronger than European growth and Japanese growth, and so that will certainly push the dollar up against the euro and the yen. But then separately, the Fed will be tightening sooner, most likely, than a lot of other central banks. And so as a result, you would expect that to have an upward sort of pressure, exerting upward pressure on the dollar and downward pressure on other currencies. I think we're already starting to see some pleasant surprises in terms of, say, UK growth, even German growth. We'll probably start to see some upside surprises for the US. That's not to say we're out of the woods. There still could be some risks out there. But it could be, we think it's probably likely, that 2014 will see something of a positive dynamic, if you will. Not a virtuous cycle, but a positive dynamic between stronger growth in the developed economies, which will pull up the emerging markets, but then in turn that'll feed back and help countries like the U.S. as well. So once you start the cycle going of growth, it typically builds on itself.